Welcome to Portfolio BI's virtual client conference and our industry panel, Assessing a Brave New World for Investment Management. Before we get started, just a few operational items for you. This session will run approximately 30 minutes. At the end of today's session, we will have an opportunity for a question and answer session. At that time, you can submit your questions using the Q&A chat function at the bottom of your screen, located to the right of the raise hand feature. If you experience any technical difficulties during this session, please use that raise hand feature and one of our point people will be in touch with you. Thank you for joining us. Jeremy, I'll hand it over to you.
Thank you, Tara. Welcome, everyone. Thank you for taking the time this afternoon. I'm Jeremy Siegel. I'm the CEO of Portfolio BI, and I wanted to welcome two of our speakers today, Steve Nadel from Stewart & Kissel, well-known attorney in the space, who known for decades and has worked with everybody on the new launch side, all the way to some of the largest funds out there, as well as Jonathan White, who is head of development at Intertrust, someone that, again, I've worked with for a very long time, and is really helping clients on their back office and operations scale and growth. I want to just give you guys a second to introduce yourselves, and then I'll ask some questions.
You go first, Steve.
Sorry, I'm just readjusting the camera because the window moved for me. Sorry about that. Hello, everybody. My name is Steve Nadel. I'm a partner at Stewart & Kissel in the investment management group. Stewart & Kissel, for those of you who don't know, is the oldest law firm in the alternative space. We actually set up A.W. Jones, which is considered the first hedge fund back in 1949. It was not me, nor was Jeremy or Jonathan involved. I work with all sorts of managers, from startups to institutional, do work with them on structuring, raising money, everything in between. On the side, Jonathan and I do a little karaoke as well. We are experts at Comma Chameleon, if you want to hear that another time.
Not today.
Not today.
Jonathan White, so as Jeremy said, I head up the fund sales group at Intertrust. Some of you may recognize me. I came through the acquisition of Vithios back in 2019. And so whilst Intertrust is the largest administrator that you've never heard of, with about 600 billion in assets under administration, I typically focus on working with managers who are going through sort of operational transformation view, thinking about potentially combining outsourcing with technology and adjusting technology. And obviously, this is where I work very closely with Jeremy. Steve, I say longtime friend, karaoke partner, and looking forward to being here and getting into it, Jeremy.
Great. Thank you both for being here. So let's start off a question. Just in the last year and a half, 2 years, so 2020, 2021 has been a little bit crazy, as we all know. The industry operations and the ODD process have really shifted quickly from being an in-person to cyber world. How do you see that impacting long-term? What are the challenges you're seeing in that space on running of the business on and then the ODD due diligence process?
I can start that off if that's okay. I think, you know, the pandemic in the beginning had a major chilling effect, I think, with respect to the smaller or the lesser known managers, because typically before the pandemic, the big allocators would want to have in-person meetings to come in and sort of kick the tires. What happened, though, as the pandemic continued to sort of drag on, I think a lot of these allocators, I'm not saying all of them, but a significant amount of them started to get much more comfortable with a couple of things. One was relying on references primarily from other allocators, so they speak to each other. So if you know, an Axia and say a Blackstone, maybe they're exchanging notes on a manager, that's one thing. We saw much more sophisticated, almost like movie-like productions, videos being made by some managers to give sort of virtual tours. We saw much more complicated data rooms being set up. And what developed as a result of this, as the pandemic continued, was more and more managers were being seen, considered, and ultimately invested in by these allocators.
So you see this as a positive. What are the negatives you've seen on that in the sense of being virtual? Have you seen Is it just all positive, all rosy, and we're moving forward?
I think the virtual was generally positive. I think look, I'm not going to pretend to be an allocator. I think there's something to be said about meeting somebody in person and meeting the team in person and actually walking around the office and seeing physical presence. And I do think ultimately, as things get better with the vaccines and all that, and the pandemic starts to calm down, you're going to see sort of, I would call them ratification visits, just to make sure that any allocations that may have been made during the pandemic based upon sort of purely virtual visits are sort of certified, so to speak.
If I might add to that, I think, look, we've all been impacted by this, right? And I think for some of us, I'll put myself in that cap, absolutely loving getting back into the office, absolutely loving getting back in front of people. And some of the allocators that I've been speaking to, they appreciate we're in the business of being human, right? So that face-to-face interaction, the personal connection, gaining trust is so far easier done in person. And so even though the allocators have done well in adapting to a model, right? They have to deploy capital, they have to do due diligence. Managers weren't accepting people into their offices for the most part. I've heard some managers made exceptions for allocators. But I think the ones that I speak to are absolutely, we need to get back to some level of normalcy. We've made it work, but there's no substitute about being able to walk into an office, gain the atmosphere, understand where the people are, walk around. Now, obviously, they're not pushing to go into an office because maybe the managers aren't back in the office, 100% either. So they're being patient. They're making it work, but I think ultimately we see a business that goes back to much, much more in person, and this component doesn't stay remote.
Right. I think the one thing that's going to be interesting to just watch here, obviously returns were, I think, pretty good in the industry last year. They seem to be pretty good this year. And the allocators, unless they're like one-off investors, but if they're like fund of funds, or they have people that they report to, and they're seeing these positive returns in this remote environment, and on top of that, maybe lower expenses because they're not paying the allocator share of massive travel and hotel costs, that's going to put pressure on this remote model in a sort of in a positive way to continue to promote it. So that'll be an interesting dynamic to consider.
Yeah, I would just add to that. So from my perspective, the fact that we can be remote enables you to hire talents that you normally would not have had access to, right? So we've been stuck to these central hubs, London, New York, Boston, Chicago, Texas, California. Now we can get someone in Des Moines, Iowa. You can get someone in Montana. I myself have hired some staff in remote locations of the US. There's great pockets of talent. The salaries are significantly different in line versus New York. The expectations are different. So I think there's a lot of opportunity that we're seeing. Do you guys see that as well, in the sense of, growing the business, and so going back to normal? What is normal if people are going to be remote long-term? Are people going to be in an office hybrid? How do you see that working out?
I think you're going, well, look, I'm a lawyer. For us, the challenge is severalfold. Number one, if we have people, we're a New York-based law firm primarily. If we have people suddenly sitting in Oklahoma and Alaska, it's fine, I can reach them over the phone. But number one, you may have time difference issues, which may impact the client base that you're trying to serve. And number two, you're now doing business in another state. Does that increase your tax tax footprint? And also, do you have to be admitted in those states? Does liability change? Does your insurance change? And I think it also creates sort of, in my opinion, from what I'm hearing across not just the legal industry, but across the board, less stickiness. You can't implement culture. You cannot create any sort of loyalty. People are just jumping around. Going back to what we were talking about before about the due diligence, if you're continuing to do remote, which means you're relying on so much computer use as opposed to having a nice meeting in the office, think about all the cyber and privacy issues. You have 5 people on your due diligence team thinking of making $150 million investment to some hedge fund manager, and then suddenly somebody hacks into that call and hears everything you're saying. Whereas if you're in a meeting in the office, I think it's a lot harder to do that.
Yeah, I think also, so it's an investment in people, right? So some of the business is driven by the people. Steve's business, you think about your implementation team, Jeremy, getting close to the business that they're working alongside, right? Same in ours, is how the people component of the business, you need to have people to interact. So even though we've been fortunate enough to be able to send our entire operations and a back office workforce to their homes, and we did that seamlessly, and we managed the volatility and all of those things. And so we give ourselves a pat on the back. And a lot of service providers did very well during the initial stages of the pandemic. You're losing certain components of the culture, right? And so we pride ourselves on service culture. We pride ourselves on instilling the right values into the people. And you do that from within the office, people to people interaction. You sort of lose some of that creativity and back and forth. And I tell you, like some of the projects that we've been working on, you know, it's so much harder to have like this thoughtful, creative conversation that's built on trust over these video screens, even though we're doing it today, right? And we can do very well at it, but there is no substitution to actually being in front of people. And that's certainly the joy I feel every time I go into the office, even though maybe there's only 3 of us there and we're all spaced out. At least we're communicating with each other. And I think some of the ideas you come up with, and I think even on the investor due diligence, it's all about culture, right? And can you instill that culture across an organization that it is sort of spread across different locations just because you can do it from a remote model perspective?
Right. I think one of the things that we've seen in the industry is people went home and started working remotely, but they did that for a period of time with their existing team. We've seen a great relocation of, you know, people in the industry, in jobs in the workforce. You see about the Wall Street Journal every day. People are switching jobs. So now the question is, when you talk about training and bringing on boarding new people, culture, how does that play out? And I don't think that we've really experienced that yet. I think we've really been working with, you know, maybe a couple of new people, but most of it's been the same team that you've been working with for years. So now you just went remote, versus really going to a remote model long term is questionable. The only other thing I see is PMs. So you're seeing a lot of portfolio managers move to Florida. You're moving to
Right.
other locations. So that's the good thing is, you know, they're also expanding and things get led from the top. So if you're at a hedge fund and your PM is saying, I don't want to live in New York anymore, you know, that's going to be an interesting dynamic. We'll have to see how the returns get affected, if they get affected. It might, you know, be a positive, it might be a negative. We'll have to see how that plays out. All right. So the next thing I want to talk about is on the transformation to digital. So, you know, we're doing a lot of digital transformation, future proofing, opportunity, challenges. What are we seeing there? Jonathan, do you want to take this one away?
Yeah, digitalization is such a buzzword right now, and I'm sort of in this weird space where I think as a service provider, we think we know what it means, and then I think there's a huge disconnect for what we think it means versus what our client base think it means. I'll give you an example. We just did a survey. This is more on the private equity side, but we did a survey about digitalization and technology. We were asking managers their utilization of certain technologies, and blockchain was one option, and over 60% of the managers said to utilize blockchain, which is absolutely crazy to think of because, you know, we know that that's not true. Blockchain is some sort of unknown future state. The challenge is like obviously managers want to think about technology. I think interspersed with that, we've seen attitudes change towards the concepts related to outsourcing. That's not a plug. That's basically if I was always focused on having people inside our 4 walls so that we could collaborate and work together, and now there's people working from home, do I really need those people working from home when I can give it to another service provider who can give me a cohesive service? But in that technology as well, I got to imagine during this period, technology initiatives and understanding what digitalization means to organization and future planning, it's been inherently harder, right? Because they're unable to sit around a table and discuss these things as well. You know, they're learning from vendors, features, the benefits, and all these different things. So strategy becomes inherently harder. And so what we've seen is, yes, managers are engaged in these dialogues around how they think about the future operating model. I think there has been an uptick in managers thinking about those operating models and how technology fits in because they've gone to a work from home environment and because they're not rushing to get back in. But inherently, those projects take longer. And, you know, we're not a billing by the hour type organization, but I imagine that those do in the consulting world are probably seeing significant uptick in their hours of billing just because these things take longer to get through. Steve.
Well, what's interesting, and digitization is not a word that I typically use in my vocabulary. I had to sort of look it up when we first started. To me, it's like technology in the industry. And it's funny you say the thing about, the hours are going up. I did read an interesting report that they said that artificial intelligence, which I guess is some form of digitization, is going to result in the loss of over 100,000 legal jobs over the next 10 years. So it's not always good. But I think technology has helped the industry in certain ways, and it's hurt it as well. Clearly, it's made things a bit more efficient, quicker, which, look, people don't sleep anymore. You're getting emails all the time. Everybody's working 24/7. Everything is instantaneous. It's certainly raising the cost of doing business in terms of cybersecurity, cyber insurance, and dealing with that. And now with the constant tentacles that people are rolling out in their organization where, they're connected with their accountants, their primes, their auditors, all these other servicers, research firms. It's just that many ways of exposure of the firm. So clearly it's good in a lot of ways, but it's you have to balance it. I think on the, that's more on the management company level. I think on the fund level, I think it's made it to some degree more challenging for some people to generate alpha. I mean, the quants, in my opinion, have killed a lot of the long, short, and value guys who, or the sort of the regular investors who weren't relying on computer models, because all the alpha is getting plucked right away by the quants. So I think from that perspective, it's changing what people are investing in. I think it could ultimately, in certain sectors or strategies, drive down fees for the industry. So I don't know. It's a mixed bag, in my opinion.
I just wanted to add what I've seen on the spreadsheet side. So we, as you mentioned, it's the 24/7 world, and I find that people want to be on demand when they want to get their information when they want to get it. And the idea of sitting in the office and grabbing a spreadsheet update from someone doesn't really work if you're working in the middle of the night. So I see a lot of digitization of really getting off of manual processes. And the sell side did that years ago mostly by push from the regulators and internal risk teams, but they're pretty much off spreadsheets now. But the buy side is still heavily reliant. With whatever automation they have, it still winds up on a spreadsheet at some point, whether it's going out to an investor or whether it's going into a PM or whether it's going on research. It's still in spreadsheet world. And I think that there's a lot of that people are realizing, all right, that really worked. You mentioned the idea of having your team, in your office. Once they leave your office, the idea of having that spreadsheet mentality, does that go away? And you mentioned outsourcing, but I definitely think that's the big piece that I think we're going to see is people are saying, all right, I can't do this way anymore. It's not scalable. It's not reliable. What if this person does leave, or they're just not around? What do I do? So I think that's definitely a challenge.
Spreadsheets are a great delivery tool in receiving and transferring information. It's a very bad processing tool. It has inherent risks. It can corrupt. It's not time series. But there's no substitute in a digital world for having data go out as data, not as a spreadsheet, from a machine, right? That's been validated, and have that go out so it's protected and it's correct. Can I just add? And I saw a question pop up, right? When we're talking about digitalization, this is one area that I really do think that digitalization is going to have an impact is around the world of ESG. Lots of groups who are working on sort of AI tools that are going to really help the audience right here, and predominantly liquid managers, with what is coming down the pipe related to ESG. I was over in London, fortunate to be over there a few weeks ago with the folks over at HFM for their Operations Leader Conference. And not almost every panel, we talked about outsourcing, we talked about data ecosystems, and almost every panel focused on the requirements over there from an ESG perspective, both investors and over there regulators as well, how they're portraying to investors their positions in terms of ESG. And obviously the regulators are interested in that. AI is obviously a tool that we're seeing that's being applied to the ESG conundrum. We're in the early stages of ESG and the data and agreeing on taxonomy and all of those things. I really see it making an impact there, to be honest.
Okay, interesting. Another question, just in the sense of data transparency for investors. So, when investors are traveling, they have less time on their hands, but when they're sitting at home, they ask for much more in the way of data and reports and transparency. Steve, what are you seeing on the legal side when it comes to that? And then Jonathan, you can follow up with what you're seeing on the operational side when it comes to investors' requests, because they want to see position level. They want to see it real time.
I'm certainly not a big fan of giving individual investors position level transparency, especially if it's real time. I think you run into sort of almost like a quasi insider trading situation there, because if one investor knows that you're in a position and they know that something just happened in the market in that position, then that investor can put in a redemption notice while the other investors don't have the information on which to make that redemption decision. So I am typically very strongly opposed. If investors are giving out, if managers are giving out portfolio level information, I'm always recommending that it be significantly lagged, maybe once a quarter, 45-day lag, similar to like the 13F. If they want to do something more frequently, I suggest to them that the best practice is to do top 10 and bottom 10 and offer it to everybody. Because if you start cherry picking, that's when you're going to start getting into issues with the SEC.
So this is the great conversation, because when you ask a lawyer, that's the answer you should get. But then, Jonathan, you get the request for this investor wants it in this format. How do I get them this information in this spreadsheet? Because I'm getting it for all my other managers in that spreadsheet. So now what do I do?
So it is interesting. I think, one of my favorite topics is complexity. And when we talk to the average CFO of a hedge fund out there, the complexity is not the asset class and the strategy. The complexity is always about this very topic, right? Dealing with investor requests for specific data, and the time that investors are sitting there thinking about these exotic questions, they're just like, how can I look at this through a slightly different lens, put it on the CFO's desk, and they've got to go and they have to know where to go get that data, right? Which is typically from disparate sources. And then they have to know, and this is their value, well, I know how to stitch this data together to actually address the question, right? That's not a junior level function. So that's often where their complexity comes in. So having a more seamless approach to those data sets and the one source to be able to gather that information and have the flexibility to slice and dice and time series and all of those things are super critical tools. And this is not going away, right? This is just getting more and more burdensome. And I'll go back to my other point on ESG. Those requests will be now talking about ESG and how they categorize their investments, what data source to use, why did they choose that data source one versus another, right? They don't want to be called greenwashing. So this is the way, and I'm always interested, right, to talk to managers and ask the question, what do you see 5-10 year window, right? Not what are we looking to challenge today, but how do we think about, or how are they thinking about that in a 5 to 10 year window? And I know some managers that have sort of not given up, but certainly have like deprioritized this building SQL tables to assemble data for the back office, right? They're much more in an agile environment where they're actually applying technology, right, and AI to look for opportunity versus having a whole tech team that's building around, the traditional data warehouse reporting engine. I'm sure that, Jeremy, this is where you guys fit in, right? You can slice in there. Not to do a plug there.
Shameless plug for the data warehouse.
Shameless plug. Why not? I got it in there. I feel good.
Thank you.
But that is culturally managers shifting, thinking about technology in an alpha-centric way, right? Let's get some more of these standardized tools and stop having tech teams do these things in-house when the tech team can actually be, bringing options to portfolio managers in terms of, explore this area. We found some correlations based on, our algorithms that we put into place. So that's sort of, that's what I see.
I definitely see, to your point, a lot of folks focusing on one set of data. So whether it's front office, mid office, back office, operations, investor relations, they're all feeding off that same data tables. So instead of each having their own spreadsheets and making them, modifying them a specific way, they're all working off of the data warehouses where they can customize it. Most of the projects we're working on the data warehouse side happen to be investor reporting specific, where they're trying to get, information out to their various investors in a way that they've just been doing it manually in a spreadsheet until now, and it's just not effective. And I think when these businesses started up, what they were doing made sense. You can start off doing things manually when you have one fund and you have two prime brokers. And then when the world grows and Steve keeps helping them add new products, new funds, there's new things like ESG that come out, there's new compliance rules. That's when these spreadsheets, that's where these things go wrong, right? And that's where they, try and make these tools continue to work, and that's where they outgrow them. It's not like they
Jeremy,
start off that way.
the one thing I would just add, I don't want to be the wet blanket, lawyer here, but one of the biggest issues that I have when I have conversations with clients about things like side letters, special deals, special transparency, the biggest inherent conflict you see within a hedge fund is between the marketing team and the sort of operations, compliance, legal team. Because the marketing people's job is to sell, sell, sell. They don't necessarily, they may not be sensitized to these sorts of issues. I always say the teams need to be working together. And I think different managers, and I'm very often having conversations with clients, depending upon how sophisticated they are, where they are in the sort of growth chain, 1 to 10, how risky this is. A younger manager who is new to the business and trying to raise more money, my guess, typically they're going to be a bit more risky and willing to do things that a more established, bigger target manager won't do. And I think that's an important conversation that needs to be had with all the clients.
Let's flip back the question here and ask, right, when do managers say no to investors, right? Because at some point, I think there's a suspicion of managers that the investors are asking questions.
No,
they're providing these data.
I may not look scary, but sometimes I could be pretty scary. And if I tell a manager there's no way you should do this, I'd say 95% of the time they're going to listen. But I don't typically say no way, but I do try to paint the risk and I explain where the issues are, and then they make an educated guess, an educated decision, I should say.
I think a lot of these turn to be managed accounts and funds of one. So it's, again, that spreadsheet worked when you had one commingled fund, but then all of a sudden you start adding these side products and then you have to figure out the allocation. And I think that's where things get challenging. So you have investors that are asking for that transparency, but they're asking for, performance attribution that they're not getting natively from their systems.
Right. Well, look, if it's a managed account, though, they already have the portfolio transparency, so it's a little bit of a different issue. What gets a little tricky sometimes, though, is some investors have money in a managed account, and they may also have some money in the funds, and then they're using the information they're getting from managed account to potentially make a decision in the fund.
That's a problem.
That's where it gets a little confusing.
That's a problem. Right. I can see that issue. Then you're getting transparency that as an investor that they shouldn't have in the commingled fund. Interesting. All right. So I think we're pretty much at the 5 o'clock range. We want to kind of open it up for questions. So I don't know if there's any specific questions from the audience. I can't see the queue.
Actually, Jeremy, we have a number of questions that have come in.
Okay.
And the first is, what should I think about or challenges dealing with SPACs if there's an investment option that we're evaluating?
I guess what I would say from a legal standpoint is, does your fund allow you to invest in SPACs? Is it an affiliated SPAC or not? What are you going to be doing with respect to the SPAC? There's a whole analysis when it comes to SPACs. Is within your investment profile. I mean, I'd be happy to talk to this person offline, but this is, it's a fairly intense conversation.
I see the next question was about, thank you, Steve, is about the cloud and what's the urgency or the competitive advantage of moving to the cloud. So I think people need to understand what the cloud means, and it's different things for different people. Most of us are already on the cloud. Your iPhone is already there. People are using Office 365, they're already there. The question is, who's managing the cloud for you? So the cloud is really a location. It's where your state is being stored. It's on a hybrid of servers. The question is, who's managing that for you, and do you have connectivity to it? So you can go into a private cloud, you can go into a hybrid cloud, you can go into the public cloud. And I think, specifically what we focus on is the public cloud, which is Amazon AWS, it's the Google Cloud, it's the Microsoft Azure Cloud. And those are the ones where we are doing it in the client's name, so they're keeping the keys and the ownership. And I think that's the important piece, is when you're doing due diligence, we talked about that earlier, is knowing where your data is, knowing who has access to it. And I think the cloud gives you a lot of tools to basically review and do cyber work to understand where your data is being housed, who has access to it, and if you have to cut off a user, how do you do that? Versus, again, your people are emailing spreadsheets back and forth into inboxes. This is a much more automated way, and there's a lot of reporting tools involved. But I think the reality is we're all moving to the cloud. The question is, what's the best way to do it? What's the most efficient way to do it where you don't lose control? And I think that's the biggest part of running any business, is control of your data, control of your systems, control of your providers. And that's the benefit of having like an InterTrust, where you're having someone help keep an eye on those providers for you, and they're managing data for you as a sub service, or you're managing it yourself. Even when it comes to the legal side, where are your legal documents? Where are they being housed? How can you get access to them? And a lot of that stuff used to sit in file cabinets. Now it sits online. How do you make sure those living documents are being followed if you hit a nav trigger? So those are types of things that you could have availability on the cloud and go work from anywhere in the world and have it work assuming you have internet. And I think that's a big advantage for the industry. I think that will definitely continue to expand the idea of people moving to more and more remote locations.
Yeah, I think the cloud offers well implemented, those of us experienced like the fully implemented cloud solution, just far more elegant, right? And single user sign-on for everything. So you can, the user then is out the door and you can cut them off straight away, can restrict access, right? It's a much more elegant way of doing it.
The thing I like about it the most is the upgrade path. So when you're on the cloud, you're being updated on a real-time basis, whether it's daily, weekly, monthly. Your iPhone is always being kept up to date. Your desktops do that now, so that there's no forklift upgrades and you have to move from one crazy version to another, and you realize that you have to do this crazy migration and it's going to cost hundreds of thousands of dollars. Your systems are being, if they're cloud as a service, they're already being kept current. And I think that's a huge piece, and especially when we talked about newer managers. If you're a newer manager that doesn't have a huge IT team, you're really leveraging the cloud to be there to help keep you current. Cybersecurity policies and procedures are pushed out to all of the organization, updates. And I think that's a big piece that people forget about. They think of it as just storage, but you really have to think about is, what's it providing to you, and keeping you current is one of the things you're doing due diligence about, right? When you're doing due diligence on a business, you want to make sure that they're current, that they're following procedures, that they're taking it seriously. And when you're using the public cloud, you have a lot more transparency into showing that.
Agreed.
Let's see. I think that's it on the questions. Well, I guess on digital assets. So, okay, we have to talk about this because, Jonathan brought it up. The idea of cryptocurrency. I just heard something from Morgan Stanley's CEO. He says it's not going away. More and more I keep hearing about people trading it. Yet, the technology is not necessarily there in the sense of, if you actually own it yourself, you realize how hard it is to trade it. Where do you see it, Steve, from a legal perspective? What are your clients asking you? And then Jonathan, from a reporting perspective and an administration perspective, you definitely can hit on that as well.
Yeah, I coincidentally put up a little predictions this morning on LinkedIn, and one of them was, more ESG, and obviously another one was more cryptocurrency stuff. I don't know that we're 100% there yet with crypto. I think there's still uncertainty from a government standpoint and from a sort of an institutional acceptance standpoint, but it's here to stay. I agree with that. I think there's a lot of regulation that needs to come out in terms of, is it a security, is it a commodity, is it something else? How do you deal with it from a tax standpoint? What gets custodied and how does it get custodied? But we're in the early stages of this sort of phenomenon. I don't even want to call it a phenomenon, development, I guess is a better word. And it's here to stay, no doubt about it from a legal standpoint.
Yeah, to we did a survey early this year. We love our surveys, right? So we did a survey, and we actually asked managers greater than $1 billion, how many of them thought that crypto would be a large part of their portfolio. I think the response was like 60% anticipated at least 10% of their portfolio being crypto assets, right? I think from the manager perspective, Steve touched on a couple of the points. Transacting in these digital assets, right? It's not all just Bitcoin on Coinbase, right? It's the broad digital asset conversation, but transacting and custodying those digital assets, and then obviously then being able to marry those up in terms of an asset class with the rest of the portfolio. For a provider like us, it's just another asset class, right? So it's not, our challenge is to make sure, well, how are we going to mark this, right? What is the valuation of the digital asset? And that can get inherently complex and philosophical, let's say. But yeah, it's happening. I think managers need to prepare for it, right? Because if that many managers think that they're going to have 10% of digital portfolio, they need to prepare today of exactly how they're going to operationally handle it.
What I do think is funny is that we talked about ESG and responsible investing, and then we talked about cryptocurrency, which people that are doing, crypto mining are using tons and tons of power. So I think that they're a bit at odds with each other at today's kind of point in view. So people that are very serious at ESG, I'm not sure how they're going to be doing crypto in its current format unless they start doing it solar.
Jeremy, it's
really
very interesting
point.
you say that, because one of my nephews is a crypto miner. It's on the side. And I actually discussed that with him, and he said that a lot of crypto mining is done with recycled, energy or whatever. It's a little bit beyond my expertise. So maybe there'll be an ESG sort of overlay on crypto mining. Who knows?
So that would be interesting.
It's going to have to be, because you got this, the investors are going to drive more towards ESG. That's clear, right? That's where they're going to, they want to see investing in ESG or investing in ESG responsible companies, but the crypto returns and the promise, obviously they want returns as well. So there's going to have to be at some point a coming of the world to think about a more eco-friendly way of mining for digital assets.
Agreed. Yeah, you've had foreign governments shut down entire facilities where people are, setting up, and there's definitely recycled hardware, old laptops and things in there, but they're using up significant amounts of power from these small countries, and they've shut it down. So it's definitely becoming more and more of an issue. So I don't think it's going to take long to play that out. I think you're going to find more and more that the costs of running these things might outweigh the returns in the short term until they figure out the technology. But it's definitely something I watch. When I talk about ESG, because ESG is the hot button, and then 2 seconds later they talk about crypto, and it's like those definitely are not in sync today. I
shall tackle the next investor I'm on a panel with who talks about ESG and crypto in the same breath. I'll tackle that.
I want to log in and watch. All right. Well, I want to thank everybody for dialing in today. I think we got to all their questions, and happy to take some more offline and forward it to the panelists. But thank you for attending. Thank you, Jonathan. Thank you, Steve, for being here. It's great to see your faces in person on the computer. Hopefully we get to see each other in physical person at some point soon.
Thank you, Jeremy. Thanks, Steve.
Amen.
Thank you,
Be safe, everybody. Take care.
Yep.